Personal Lines License Test Questions. Welcome to the quiz. In insurance, what is a rider or endorsement? Is it A, a document that amends or changes the original policy? Or B, a person who is an additional insured on the policy? C, a form used to report a claim? Or D, a receipt for a premium payment? The answer is A rider or endorsement is a written document attached to the insurance policy that modifies, adds, deletes, or changes the terms, coverages, limits, or conditions of the original contract. It becomes part of the policy. An additional insured is a person or entity added for coverage. A claim form is used to report losses. A premium receipt proves payment. Because endorsements alter the policy itself, this is their function. Next question. A personal articles floater, PAF, is best described as what? Is it A, an inland marine policy for scheduled personal property? Or B, a policy covering watercraft? C, an endorsement that increases liability limits? Or D, coverage for items floating in a swimming pool? The answer is A personal articles floater is an inland marine policy or endorsement that schedules and provides broad open perils coverage, often worldwide, for high-value personal items like jewelry, cameras, art, or musical instruments with agreed value or replacement settlement. Watercraft has separate coverage. Liability increases are umbrellas. Pool items are unrelated. Because PAF uses inland marine for scheduled valuables, this describes it best. Next question. Which of the following best describes peril in an insurance context? Is it A, the cause of a possible loss, such as fire or theft? Or B, the person or property facing a potential loss? C, the condition that increases the chance of a loss? Or D, the financial loss that occurs? The answer is In insurance, a peril is the actual cause or event that leads to a loss, such as fire, lightning, windstorm, theft, vandalism, or water damage. Policies either name specific perils that are covered or use open perils language that covers all causes except excluded ones. The person or property exposed to loss is the subject or risk, not the peril. A condition that increases the chance of loss is a hazard. The financial loss itself is the result or damage, not the peril. Because perils are the named or potential causes of damage, this definition matches the standard insurance usage. Next question. The additional living expenses coverage in a homeowner's policy would pay for. Is it A, upgrading to a luxury hotel after a fire? Or B, the cost of rent and restaurant meals if the home is uninhabitable due to a covered loss? C, the mortgage payment while the home is being rebuilt? Or D, the cost of commuting to work from a temporary location? The answer is B. Additional living expenses, ALI, also called loss of use coverage in a homeowner's policy, pays for reasonable increased living costs, such as hotel bills, restaurant meals, laundry, and other expenses when the insured cannot live in their home due to a covered loss. It is meant to maintain the insured's normal standard of living, not upgrade to luxury. Mortgage payments are not covered as they are not increased living expenses. Commuting costs are typically not included. Because ALI covers necessary extra costs like temporary housing and meals during uninhabitability, this is its purpose. Next question. In life insurance, what does the grace period allow? Is it A, time to pay an overdue premium without a lapse in coverage? Or B, a period where full benefits are paid even if premiums were missed? C, time to change the policy's beneficiary? Or D, a period after policy issuance where the insurer can still contest the application? The answer is The grace period in a life insurance policy gives the policyholder extra time, usually 30 or 31 days, to pay an overdue premium without the policy lapsing or terminating. During this time, coverage remains in force, and if the insured dies, the death benefit is still paid minus any overdue premium. Full benefits without premium payment do not occur. Beneficiary changes can be made anytime subject to policy rules. The contestability period is separate and allows the insurer to challenge the policy for misrepresentation, usually during the first 2 years. Because the grace period prevents immediate lapse for late payment, it keeps coverage active for that short window. Next question. What does a single limit liability coverage in an auto policy mean? Is it A, one combined limit applies to all bodily injury and property damage from one accident? Or B, there is one limit per person for bodily injury? C, the limit applies separately to each injured person? Or D, it is the minimum limit required by law? The answer is A. Single limit or combined single limit, CSL. Liability coverage provides one total dollar amount that applies to all bodily injury and property damage resulting from a single accident regardless of how many people are injured or how much property is damaged. Split limits separate bodily injury per person per accident and property damage. Separate application to each person is part of split limits. Minimum limits are set by state law, but CSL can be higher. Because CSL uses one overall limit for the entire accident, it simplifies coverage compared to split limits. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.